All right, welcome back. Now, if you were with us a few weeks ago, you'll remember we walked through a case for hedging a potential ceasefire in the Middle East. Well, today we are doing a complete 180. The data has shifted and shifted dramatically. What looked like a possible path to de-escalation is now looking a lot more like a trap for investors who aren't paying attention. We've got to talk about why the market is seriously underpricing the risk of a massive volatility shock.
So here's the bottom line for today's explainer. We think the Israel-Lebanon ceasefire extension is what traders call a dead cat bounce for peace. A brief, misleading recovery that's actually hiding a much, much bigger problem. The market is pricing in a piece that the facts on the ground just don't support. And that kind of mispricing? Well, that creates both huge risk and, for the savvy, a pretty rare opportunity. So let's be crystal clear about this pivot. A few weeks ago, our analysis was really built on the hope that diplomacy would win out, that tensions would genuinely cool down. Today, we are flipping the script and focusing squarely on the bear case. This is a strategy built on the hard reality that the most important negotiations have already failed, and now the global financial system is staring down a major liquidity shock that the market, for some reason, just hasn't woken up to yet.
Okay, so let's get into it. Here's our roadmap for today. First, we're going to break down why the current calm in the market is totally an illusion. That's our dead cat bounce. Then we'll get into the diplomatic reality and why the talks really fell apart. After that, we'll look at the hidden economic war being fought with insurance policies. Then we'll explore how investors are walking right into a trap, the specific trade that could benefit from all this, and finally, what it all means for our new global economic reality. Right, so let's start with this idea of a dead cat bounce. It's a pretty grim term, I know, but it fits perfectly here. What we're seeing is a temporary relief rally that's just masking a much deeper, completely unresolved conflict. The market has grabbed onto one piece of good news and is choosing to ignore all the critical bad news that surrounds it. And this timeline just lays bare the market's flawed logic. You can see it's reacting to headlines, not to the fundamentals. On April 7th, that initial truce talk sent oil prices tumbling as the war premium just vanished. But then look at April 21st, the really crucial US-Iran talks completely collapse. The market barely blinks. Instead, 2 days later, it decides to celebrate the far less important ceasefire extension. That right there, that disconnect, is what we're talking about. This has created what some analysts are calling a geopolitical bubble burst. All the investors who piled into safe havens like gold and the US dollar are now rushing for the exits, unwinding those positions. And that creates this totally false sense of security. They are celebrating a temporary tactical pause as if it's some kind of permanent strategic solution. And that, right there, is the very core of this trap. So, this all leads us to the real heart of the problem, the diplomatic reality. As soon as you look past the optimistic headlines, it becomes painfully clear that the foundation for any kind of lasting peace, it's just not there. In fact, it's already crumbled. This table just breaks it down perfectly. The market is a laser focused on that top row, the Israel-Lebanon track. But honestly, that's just a symptom. It's not the cause of the disease. The real engine of conflict in the region is the US-Iran track, which, as you can see, has totally and completely failed. That failure is the real story, and it's the trigger for this entire ceasefire trap. And listen, this isn't just some minor breakdown in communication. This is a public, defiant refusal to even come back to the table. Iran's foreign ministry isn't saying, hey, let's talk later. They are on the record saying they have no plans to attend, and they're pointing fingers citing specific violations. This slams the door shut on the very diplomatic optimism that was fueling the market's rally. But the market still hasn't priced in just how final that statement really is. Okay, so let's shift gears from diplomacy to economics for a minute. Because while all this drama was unfolding in negotiating rooms, a completely different kind of war was being waged on the water. We have to look at the reality of what's happening, which reveals a blockade that no ceasefire agreement can just magically wish away. Yeah, officially, there might not be warships firing at this exact moment. But from a commercial, a financial point of view, the answer to this question is a loud and clear no. The waterway is, for all intents and purposes, closed for business, just not in the way you might think. And let's just remember the stakes here. This isn't some backwater shipping lane we're talking about. A full 1/5 of the entire world's oil supply passes through this one narrow choke point, not to mention about 1/5 of its LNG. Any disruption here isn't a regional problem, it is a global economic earthquake. So what's actually causing this blockade? Well, it's not mines in the water. It's math on a spreadsheet. The Joint War Committee at Lloyd's of London, these are the folks who underwrite global shipping, has labeled the entire Persian Gulf a high-risk zone. The result? War risk insurance premiums have shot up by over 1,000%.
They're calling it an actuarial closure of the strait. To put that number into perspective, we're talking about an extra cost of nearly $1 million for a single tanker to make a single voyage. That just makes it commercially impossible for most operators. It really doesn't matter if the waterway is physically open if nobody can afford to actually use it. This is the insurance weapon, and it's creating an incredibly effective blockade using pure financial pressure. And as this table shows, the fallout goes way beyond the gas pump. Just look at sulfur. 45% of global exports go through Hormuz. That's a key ingredient for fertilizer. Methanol, essential for plastics, is at 30%. This kind of disruption creates what analysts are calling a pizza economy, one that's always leaning towards stagflation because the fundamental ingredients for global industry are getting choked off at the source. So this all raises a really critical question. How are so many smart people, so many investors getting this fundamental picture so incredibly wrong? The simple answer is they're walking, eyes wide open, directly into a trap by making a super high-risk bet that this fragile piece is actually going to hold. To really get the trap, you have to understand a concept called theta decay. The melting ice cube analogy is perfect. Options lose a little bit of value every single day just because time is passing. So investors can collect this decay as income by selling options. They're basically getting paid to wait, betting that nothing crazy is going to happen before that option expires. And this slide just lays out the trap perfectly. Step 1, assume peace will hold. Step 2, sell volatility to collect that nice, steady income from the melting ice cube. But step 3, that's where the real danger is. This strategy leaves them short gamma. Now that's a technical term, but think of it like this. It's like building your house directly on a tectonic fault line. You're perfectly fine as long as the ground doesn't move, but you are catastrophically exposed to a sudden, violent earthquake. When the trigger comes, and all the diplomatic signs suggest it will, the result is a massive, violent spike in risk that can completely vaporize an entire portfolio. Now, here's the flip side. Whenever there's a major mispricing in the market, it creates a real opportunity for the investor who's actually prepared. This gap between what the market thinks the risk is and what the actual risk is, that's where you find the alpha, or the outperformance in this whole thesis. So how do you trade this? Well, instead of selling volatility, you buy it. You can use a strategy like a long strangle. All that means is you're buying two options at once. One that makes money if the market explodes upwards, and another that makes money if it crashes downwards. You see? You don't care which way it goes. You are making an explicit, defined risk bet that a big move is coming. You're betting on the earthquake that all the volatility sellers are pretending won't happen. And the data on this slide is already dropping hints that a shock is on the way. Look at these key metrics. Implied volatility, or IV, that's what the options market expects to happen in the future. Historical volatility, or HV, is what's actually been happening recently. In both cases here, IV is higher than HV. That's the market pricing in that the future is going to be way more volatile than the recent past. That gap is like the market subconsciously bracing for impact, and it creates the perfect setup for a long volatility trade before the real panic kicks in. But this is about more than just a short-term trade. What we're seeing unfold isn't just a temporary disruption. We are witnessing a permanent structural shift in the global geopolitical and economic landscape. This is the new normal. The ripple effects from this are systemic, and they're going to be with us for a long time. That pizza economy means we're facing a constant threat of high inflation and low growth. These supply chain problems aren't quick fixes. Rerouting the entire world's shipping fleet adds weeks and millions in costs to every single voyage. That kind of logistical replumbing takes months, sometimes years, to normalize. On top of that, emerging market currencies are getting hammered, and the global defense industry has entered a brand new supercycle. These are not temporary shocks. These are the defining features of a new economic era. And that brings us to our final thought. The market's desire for peace, for a return to normal. It's completely understandable. We all want that. But in a world where the data clearly shows that conflict is becoming more structural and risk is more persistent, maybe the biggest risk of all is just assuming that peace is the default outcome. The ceasefire trap has been set by that very assumption, and the price of falling into it could be absolutely devastating.